Secondary funds have become a critical component of private markets, offering investors a way to access mature portfolios with more predictable outcomes. One of the most notable differences between secondaries and primary funds lies in their cash flow behavior. Understanding these differences is essential for accurate modeling and setting investor expectations. How secondaries mitigate the J-curve. Primary private equity funds typically exhibit a pronounced J-curve. Early negative returns driven by management fees and investment costs, followed by positive performance as portfolio companies mature and exit. Secondary funds, by contrast, acquire interests in existing funds or portfolios that are already partially or fully invested. This means reduced early losses. Because capital is deployed into assets that are already operating, the early drag from fees and unrealized investments is minimized. Immediate exposure to mature assets. Investors gain access to portfolios that may already be generating distributions, flattening or even eliminating the J-curve effect. Faster distributions and shorter durations. Secondaries often deliver liquidity sooner than primaries. Key drivers include near-term exits. Acquired portfolios often contain companies approaching exit, accelerating cash returns. Shorter fund life. While primary funds typically run 10 to 12 years, secondary funds often target 6 to 8 years, reflecting their later entry point in the investment cycle. This faster return of capital can be particularly attractive for investors seeking to manage liquidity or recycle capital efficiently. Impact on IRR and DPI. The timing of cash flows has a direct impact on performance metrics. Higher IRRs. Earlier distributions boost internal rate of return, IRR, even if ultimate multiples are similar to primaries. DPI advantage. Distributions to paid in, DPI ratios tend to ramp up quickly, providing tangible evidence of value realization early in the fund's life. However, investors should be cautious. While IRR benefits from timing, the absolute return multiple, TVPI, may not always exceed that of a strong primary fund. Implications for fund modeling and investor expectations. For allocators and CFOs, these dynamics require adjustments in planning. Cash flow. Forecasting models should reflect accelerated distributions and shorter duration assumptions. Portfolio construction. Secondaries can serve as a tool to smooth cash flow volatility across a broader private markets program. Performance benchmarking. Comparing IRRs between primaries and secondaries without context can be misleading. Understanding the timing effect is critical. Closing thoughts. Secondary funds offer a compelling way to reduce the J-curve, accelerate liquidity, and enhance portfolio diversification. While they often deliver higher IRRs and quicker DPI, these benefits stem largely from timing rather than superior underlying asset performance. For investors, the key is to incorporate these dynamics into cash flow models and set realistic expectations. When used strategically, secondaries can complement primary commitments and improve overall portfolio efficiency.